is going on, investors? It is good to see you. Sorry I was out last week. We were celebrating the end of the school year. So I'm sure if you have kids, it is now officially summer break and we are on to the summer months, but the stock market doesn't end there. So there's always something to talk about. I hope you guys have been doing well, making a lot of money in the stock market. Hopefully we can help clear things up a little bit on what's going on in the stock market. What are the directions that I see the market going here in the near and long term for the rest of the year? I hope you checked out the latest videos that I've been putting out. They've been well received by the YouTube community there. So I went through a few stocks that I'm looking at that I believe is going to outperform through the rest of 2025 here. And I talked about more near term because, you know, a lot of the videos that we put out are all about stocks we should be buying and things like that. The recent ones were all geared towards stocks to be selling. So it doesn't mean I don't like them. And if you saw that video, you know that's what I talked about a lot. And I wanted to make sure I got that point across in the fact that doesn't mean I don't like those stocks, but looking for some profit taking in some of those might be a good direction to go right there. So I hope you guys are all doing well. Let's start the same way that we always do here on the Stock Market After Hours live show. Again, my name is Mark Russin. I'm a CPA here in the state of California. It is great to be with you guys here today after being off last week. So let me know where you're tuning in from and what are some stocks, ETFs, things that you've been buying in the recent weeks. Let us know because, again, all we're centered around and all our focus is, especially here at Russin Financial, is to help others build generational wealth. We're a big community, all with that goal in mind. It's not trying to beat one or the other. It's all of us lifting up together there. So I hope you join us in our Stock Investors Edge community there, where we have a Discord. We're always talking about stocks. You can see my stocks on ETFs I'm buying and selling by becoming an Edge Plus subscriber and things like that. So let's see who's out there today. I see Hoagie, Indiana. How we doing? McVeigh, good to see you, my friend. Matthew, the king is back. Yeah, 1 week off. Had to celebrate summer for the kids. Drew is in the house. Good to see you from Minnesota. The J is back. Matthew's tuning in from St. Louis, still adding to the SCHD position. What a pullback today. Yeah, it was an interesting one where things were looking green, and then all of a sudden, we pulled back, but we were down less than 0.3% on the day at the end of the day. So nothing crazy, but intraday, yes. Mark Payson, happy wonderful Wednesday from beautiful Lehigh Valley. Tempe for Q, buying some SoFi. SoFi, did you buy that before today, or is that a new buy as of today? I know it had a good day up, almost 5%. I was going to say 5%. It was 4.7 on the day. What's your opinion on AST Space Mobile? Not one that I follow that closely, so probably not going to make any comments on it. Maria, how we doing? All right. McVeigh, good to see you. Jedi, how we doing? James. Virginia is in the house. Love it. Janet made it to a live show. Awesome. Jeffrey, good to see you, my friend. Mainly just some option plays this week. We've been crushing it over at the Options Edge Plus. Crossed 20K today. Love to see that, James. Awesome. I'm only buying REITs right now, mainly individuals, specifically PLD. That's a favorite of mine. East Group and Torino. McVeigh, SCHD as much as I can. Some Google, JEPQ and O. L tuning in from the Panhandle. I was just over in Florida last month. Been buying SoFi since January. There you go, Q. So you like that nice little uptick day there. REITs are the only undervalued sector nowadays. Now, Roland, that's a great point you bring up there, and we're constantly looking for those undervalued. Check out healthcare too. So don't forget about healthcare. And we'll look at sectors so that you can see which sectors have kind of been lagging over the past year to date, 3 months. We're going to jump right into that here in just a few seconds there. Sam sold his Broadcom position, sold 2,000 SCHD yesterday. Still my biggest position. Interesting move there. Hello again from New England. John, great to have you. So awesome. We have a great crowd here today. Again, thank you guys for joining Stock Market After Hours, and let's jump right into it. So let's take a peek first at our Fear and Greed Index just to see where markets are at overall. So as you can see, we're still firmly in that greed position. A week ago, not a lot has changed. They were at a score of 59. Today we're at 62. A month ago, we were at 62. So again, not much change overall in terms of the Fear and Greed Index. And the way to think about it, if you're new to looking at the Fear and Greed Index, is when we're in these extreme greed positions, so that's once we're over a score of 75, that's the time to think about maybe pulling back. Probably not a time that if I have some extra cash, I'm jumping in to add new positions generally for the market. And then vice versa, when we're in that extreme fear or, in around those below 30 or so, those are times when we're looking to get into the markets. The old Buffett saying, we want to be greedy when others are fearful and fearful when others are greedy. So that's where we kind of stand in terms of the fear and greed index, not pushing us one way or the other right now from that. Let's take a peek here at the sector performance. So as we could see here, we're looking out over the past year. So this is 12-month data, what we're looking at right now. The financial sector has now taken the lead, up 23%. And the thing that I like to see personally is the fact that look at how many sectors we have outperforming this gray shaded one, which is the index as a whole. That's what we like to see. In 23 and in 24, those 2 big years, we only saw 2 or 3 sectors outperforming. That was showing these mega caps really lifting the whole index higher. So right now, over the past 12 months, S&P 500's up about 13%, but we have 1, 2, 3, 4, 5, 6 of the 11 sectors. More than half of the sectors in the S&P 500 are all outperforming, carrying their weight for the index as a whole. So we have infotech at 13.8, utilities at 15.6, industrials have been doing pretty good at 18%, consumer discretionary at almost 21%, communication services at 22%, and then leading the charge is 23% for the financial sector. The biggest laggards, the only that are in the red, are materials, energy, and healthcare. So you can see there, I think it was Rowan that made the comment on real estate. Real estate's slightly below what the S&P 500 has been doing, 11.3% gain. So let's take a look though at year to date. And year to date, the biggest laggards have been discretionary, healthcare, and energy. And that's why, a focus for me has been looking at some healthcare sectors, or positions. And healthcare isn't something that I want to be a huge spot in my portfolio. It's more of a defensive spot in my portfolio. But there's some areas that are extremely cheap right now, specific stocks. Technology is actually underperforming the S&P 500, which is up less than 3% so far on the year. But again, what we like to see, a lot of sectors leading the charge. This tells us this is a more broad rally and not a laser, narrow focused rally like we saw in 23 and 24. And we can't really call it a rally, but if you look at the April 7th lows to where we're at now, very solid rally from that standpoint. You could see the 1 month move is S&P 500 up 7% just in the past month there. So let's take a look at the past 3 months here. Again, biggest laggard in a big way, healthcare. There was a lot of concerns and pressure around drug pricing. That's where Congress has actually come together looking to lower drug prices. Very rarely do we hear about Congress on both sides of the aisle working together. That's one area that they have talked about, but that's also something that's been talked about for a number of years. So take that with a grain of salt. Energy and real estate also in the red, and then consumer staples. So really a lot of defensive sectors, which were once actually towards the top, have now made their way towards the bottom as we have seen kind of this shift back to this risk on type trading for investors. And again, as we see at the top, infotech, communication services, industrial, and consumer discretionary there. So cyclical, risk on type of sectors is what has been leading the charge over the past 3 months here. Again, S&P 500 up 5% so far in that 3-month period. Now looking at 1 month, communication services has been on fire. A lot of that has to do with Alphabet and the move that they have made in the past month. Info technologies, NVIDIA, Microsoft has been leading the charge there. And consumer discretionary, Amazon has dropped off those $180 levels where, again, I was pounding the table. Even around 200 isn't a bad valuation. And now, lo and behold, you see Amazon back above 215 there. So 3 sectors now in the past month outperforming the S&P 500. This looks a little bit more like 23 and 24 that we've seen the past 2 years here. But again, everything's in the green. So that's a good thing. It's been a good month for investors. And hopefully, I know I've talked to them when we had our open enrollment period for my 6-week investing accelerator course. I talked to a lot of investors that surely they panicked. They went into this and they're investing without understanding the knowledge. And that's why I always tell people it's important to understand what you're doing before you just blindly jump in. Although there'll be learning experiences, we want to be able to limit those learning opportunities. We don't want to be losing a bunch of money and we start, in deep in the red before we figure out what in the world we're doing from an investing standpoint. No longer do you want to just follow people because they have videos out on YouTube. Trust me, I put videos out on YouTube, but I still want people to do their own due diligence, ask themselves, does this specific stock match their strategy? And what a lot of videos, a lot of articles, a lot of people on TV do not tell you is, when they're telling you to buy a specific stock, is this something to buy for the next month? Is it something to buy for the next 6 months? Is it something to buy for the next 6 years? And for me, when I'm putting out videos, I'm a long-term investor. I don't buy today with the hopes of selling tomorrow at a small profit. So you got to understand the investor and what they're talking about and what is their ultimate goal. Is it trading profits, short-term profits, or long-term profits, and things like that? That's why I recently put a video out on a few stocks that I would rate a sell. Okay. Just trying to help people. I don't own any of those positions that I talked about, but seeing what I'm seeing in terms of both valuation and technicals, something that needs to be put together there. And then today you could see pretty much red across the board, except for, energy was the top one there. And this is one that I've been talking about within my Discord community there. And if you're not yet part of the Discord community, you can join for free. We have a free chat room, but if you're looking to see my entire portfolio, get my trade alerts, what I'm buying and selling, and get our weekly edge report that goes in depth, telling you what to look out for in the market, what to be optimistic about in the week ahead, then become an Edge Plus subscriber. If you're into options, we have an Options Edge Plus subscription as well, where you can see my option trades there as well. So, and follow along. So a ton to be involved with overall, but that's kind of a look at where we're at in terms of the market performance. So now, where are we going from here? That's the big question. Mark, what, is it just free sailing now since the April 7th? Are the bottoms in? Do I think we could retest the bottoms? I'm hopefully optimistic that the bottoms are in, that April 7th is the bottom. Now, that doesn't mean that I don't believe a pullback is in store, because I still fully believe that a pullback is in store. We've gotten recent data, and today was supposed to be a grand day when the U.S. and China made a trade deal. Folks, if you haven't figured it out by now, we have to understand there's a difference between headlines and there's a difference between actual facts. And we need to read the actual facts here. U.S. tariffs on China won't change again. Okay, fantastic. U.S. China come to an agreement. When we start detailing and going through the details of this trade agreement, guys, this is essentially putting us back to where we were a month ago with the Geneva. We came to a trade deal at that point in time. It didn't even last a month. The reciprocal tariffs came back. We were on with a 55% tariff rate, 30% across the board, an additional 25% on specific goods there. That's what the deal is right now. The trade deal that was today keeps them at the same exact rate. China has a 10% tariff on all U.S. products that they purchase. That's the same as it was last month. That's the same as it is today. No change there. There's a few changes on some rare earth materials and things like that, opening up U.S.-China visa extensions. And all of this put together isn't a deal. It's, again, kicking the can down the road for another 6 months. The Chinese are saying, hey, we want to see how this works. We want to see if you stick to your end of the deal. The U.S. wants to see if they stick to their end of the deal. And remember, we couldn't even get through a month last time. The Chinese were delaying on shipments of a lot of these rare earth items and things like that. So it's very important that there's a barking aspect and a bite. The bark so far has been way louder than the bite here. So a lot of things to take into account, but in essence, they're not even putting this into details. If you listen to Howard Lutnick right here, he got questioned on, are we going to see some formalized details around this trade agreement? And he sidestepped that. We're not even going to get a write-up on it. This is purely a handshake agreement, like we saw a month ago, for the same exact terms, for the most part, that we saw a month ago. So make sure you take that into account here. And that's, folks, that's why the market didn't really rally. If this was a true trade agreement, formalized, signed off, and everything like that, you could, in fact, see a big boom here, because that takes out some of that uncertainty. This kicks it down the road a little bit, kicks the can down the road again there from that perspective. So that's That's my take so far on this trade agreement here. The other thing that we had recently was CPI. This was actually a positive in my eyes. US inflation rose 0.1% during the month of May, and it's sitting at 2.8% on a year over year basis there. And again, remember, 2.4% for regular, 2.8% is core CPI. And for those of you unaware, core CPI is pulling out some of those volatile price changes like food and energy costs. So when you pull those out and take everything else into account, that's what core CPI is. So again, they came in slightly under expectations. They were kind of in line to slightly better than expected, which is a good thing. However, as I've talked a lot about on this Stock Market After Hours, as I've talked a lot about in our Edge Plus chat, which is where I do most of my chatting in the Discord community, is for those that are in our paying subscribers and things like that. So, but the tariffs that are in place right now, the 55% on China, which is 30 across the board, and another 25 on specific products, those really haven't gone through the prices, because if you look, a lot of companies in their latest earnings report talked about having to increase prices slightly. A few of them, like the likes of Walmart, or even Walmart, talked about increasing prices, but they're trying to take on some of it themselves, but they're eventually going to have to increase prices. CNBC did a survey that 90% of the business leaders they spoke to said they were going to increase prices in some shape or form here in the next year, likely due to tariffs. So a lot of this stuff that's been sold through the first quarter and some of it through May has been non-tariff goods. Remember, a lot of these retail type companies, they're already making orders for the holiday season at the end of the year. So a lot of the goods that a lot of these companies have already had in their stores or in storage facilities were non-tariff goods. We knew these tariffs were coming in place. And by saying we, businesses knew that these tariffs were coming into effect. So there was a big front loading. And when you look at a lot of companies, you see a kind of a balloon effect when it comes to inventory. Why? Hey, would you rather buy a widget for $10? Or would you like to wait knowing that you're going to need it 3 months from now and buy it for $10 plus a 50% tariff? Well, let's just buy it now. Let's fork out the money right now. We'll have a little bit more inventory than we need, but at least we won't have tariff goods. Now, those can't go on forever because you're eventually going to sell out of those non-tariff goods. So May, for me specifically, I believed was going to be slightly impacted. I thought the CPI report would be, slightly higher here. So that was a good sign overall. But June and July is what I keep sticking to, are going to be the really big CPI reports, because there's no way around the tariff impact right there. And if we get to June and July and there's minimal effect, then I think the market's just going to go ballistic from that standpoint. And we have clear sailing. So there's still some uncertainty for businesses because, again, there's no real trade deal. It's more of a kick the can down the road and let's see, if one of the countries screws up. So from a business leader standpoint, there's still plenty of uncertainty. And when there's uncertainty, people say, well, Mark, look to the jobs market. Well, there's a lot of businesses right now that are looking and going, okay, well, we don't have clarity yet. So things could just wash away and we could be okay. So I don't want to get rid of a bunch of people if I don't have to. But if these costs continue to rise, what do they have to look at in order to maintain efficiency and make sure that they're making enough money? They're going to have to look to their employees and start making some cuts. So I still think the job market is in a solid spot. I wouldn't say it's overly strong. We had unemployment come in at around 4.2%. So we're still sticking, we're well off the lows when we were, in the low 3%, but 4.2% is nothing to be alarmed about overall from that standpoint. So, it's interesting, this spot that we're in from a market right now, which is why I wanted to make next week an important event. So you guys know that I try to have events throughout the year, but this is going to be a brand new event that I have not done before. And this is going to be a 3-day options challenge. And the great thing that I talk about when it comes to options, guys, is the fact that there are option strategies for when the market is flying high. There are different option strategies for when the market's going down. There are option strategies to hedge your portfolio on big positions you might own, and you might be telling yourself, man, I don't really want to sell these, but I am worried about the stock pulling back. Well, maybe you don't have to sell them. Maybe you can use an option strategy. And there's option strategies for when the market's just trading sideways, which in essence, in the past few weeks, it's kind of just been lollygagging away. We haven't seen any of those big moves away. So What I'm going to be doing is breaking down different option strategies that I utilize. But not just that, we're going to go into a bunch of examples and open up the trade book. I'm going to show you a bunch of trades that I've done. All of these have been shown within my Options Edge subscription, and we're going to dive right into them. Why did I choose that expiration date? Why did I choose that stock? What was I looking at from a fundamental perspective, valuation, from a technical perspective, and break it down step by step right there. So we'll be going through all of that, looking at spreads and cashiered puts and covered calls, so on and so forth, buying calls, buying puts, ways to be aggressive in the market in a conservative manner, ways to generate cash flow on stocks you might like to own. Okay, so I hope you guys join. There's a link down in the description below. Again, I'm going to tell you up front right now, there is a select few spots in this right here. Okay, there's only so many spots that I can have because I'm not going to have 100 people join and just have a slew of questions that I'm unable to get to. So that's why we have to consolidate this into about 50 total people that can sign up for this program. If you're unable to join us during the live portion, that's okay. You're going to get access to the recordings, be able to look back at those hundreds of times if you want to. Those will be yours to keep there. So make sure that if you know that you want to join this, you get signed up as fast as you can there. So you can put in your email there. That'll give you some more information to get signed up and save your spot. There's a link down in the description below. Hope to see you guys there overall. So let's keep going now. And let's talk about Jamie Dimon, who was yet again in the news. And believe it or not, I know this won't be a shocker to many of you that follow Jamie Dimon, but he was pessimistic again. So heading into 2023, it was all about a hurricane. Well, we had the best 2-year run that we've seen in recent history. So that would have lost you a lot of money. Now we have the U.S. economy is deteriorating. We're about to fall off a cliff is what we heard a few months ago there. So Jamie Dimon is saying the economy is on soft landing and is likely to head towards a weaker position here. So, and I like this one right here, has a history of sharing cautious and negative outlooks on the economy. But when you look at it, he continues to run the same path. And when you look at the same path of his bank, let's go over here. There's a good little chart here. He continues to be bearish, continues to be pessimistic, but the annual profits of JP Morgan continue to increase here. Seems like it might be part of the ploy. He's a great leader for this particular bank. I believe Bank of America's Brian Moynihan's actually better this day and age today based on the age of Jamie Dimon, based on his track record of pointing towards where the economy is going. That's, again, as of right now. I'm not saying over the past decade or anything like that. But I tend to like Bank of America more than JP Morgan, but those are the top two banks. Can't go wrong either way. But if you go back and look at how pessimistic he has been, here's the hurricane. Here's caution about America getting hit by 1-2 punches and a recession and things like that. I like this quote here. His track record of leading the bank's incredible. His track record of making economic calamity predictions, not so good. And that's 100% true from that standpoint there. So that is my take on Jamie Dimon. Let me jump over into the comment section. I know I haven't taken a peek at them and look at anything I missed, any big questions that would be helpful here. I still like ETFs. What are your Q said? What are your opinions on CrowdStrike with its 669 PE? I don't know if the PE is that high, but let's take a peek here. CrowdStrike is heading into this particular year and parts of last year. So the forward PE on CrowdStrike, and again, I always like to look at a forward PE, is only 133. So that 669, I don't know where that might be looking back. I'm not sure, but the forward PE is 133, which is extremely high. And again, it's a company it's a growth company. They're expected to actually have their earnings per share decrease this particular year. So that it's a heavy value that you're paying on this one. But then it grows at a 35% clip and a 30% clip the following years there. So CrowdStrike, the theme of cybersecurity is one that's here to stay. Again, I continue to believe that it has even more growth than AI potential for certain areas there. Zscaler is one that I own, have some CrowdStrike and things like that, but it's not one that I'm overly optimistic. Even on the pullback that it's seen recently after its earnings. It dropped from, what was it, 490s, low 490s, got to around 460 or something. So $30 or so, less than 10%. But here we are, lo and behold, back up at 477. So, it's still an expensive name, but I love the cybersecurity theme. I think there's a lot of cheaper options that are out there, but this is one of the best of breed there overall. And Roland hit it right there. Gotta look at forward PE. But even with a lot of these growth stocks, PE isn't that helpful. You want to look at other valuation metrics overall. So, all right, yeah. So like Austin put right here, forward PE for a stock like Palantir, that's not going to be helpful whatsoever. You got to look at the growth, and you're going to have to look, especially these companies. Some of these companies don't even have earnings yet, so you can't look at any of the earnings valuation metrics. Most of the companies should have revenues. If you're investing in a company that doesn't have revenue, I have other questions. But for those, a price to sales metric and things like that's going to be a lot more beneficial than a price to earnings metric overall. Austin also made a good note here. Looking at hard data, they should be cutting. This is in reference to the Fed. So there's, we talked about some reasons to be concerned. The tariff impact on inflation moving forward, jobs seem okay, and there's no real trade deal here. But there's also reasons to be optimistic long term. Near term, I'm a little bit more pessimistic. I think we could be, overdue for a bit of a pullback. But again, this is looking more at traditional from valuation technicals and things like that. But any headline, any deal that comes out or something that is out of our control could send the market soaring from that standpoint. It could be, irrational and out of our hands and that's why I take two sides saying we need to remain invested. Those folks that I talked to in my enrollment period that got out of things in early April, they were hitting themselves later in the day because they got scared with a 10, 15, 20% of their portfolio was in the red, or their entire portfolio was down by 20%. But when we zoom out, that's more of a buying opportunity, okay? The things that were being talked about wasn't going to take all of these stocks bankrupt, but by selling out of the things, that's the fear that goes into your mind, and that shouldn't be the case. Instead, you need to look and have calmness to yourself when you're managing your own portfolio. Don't let emotions get involved. Emotional investing is constantly a losing strategy. But there is reasons to be optimistic. So don't get me wrong here. Let's not get things twisted. There is reasons to be optimistic. And a few of them that I jotted down here was, number one, a lot of the things that the Trump administration ran on was around deregulation. I don't think we have even seen a small portion of that yet, because all of the focus has been on tariffs and trade. We're starting to see the focus turn slightly towards taxes and the tax cut and things like that. So that's going to be another growth driver. We could have a full-on other conversation on how that impacts the overall deficit and budget. But from a business standpoint, how it affects the corporate world, that could have a nice little growth factor there for businesses. Small caps is an area that's been hit rather hard. If you're looking for, hey, I want to take a little bit more risk with a little more pop potential upside, small caps could be a spot to look at there. So there's deregulation, there's tax cuts, and then what Austin was just talking about there is still in the back pocket is going to be Fed cuts, okay? Interest rate cuts from the Fed in particular. Those will be coming, which could drive growth even further. We're starting to see, if June comes and goes and CPI and PPI and things like that show us that, hey, inflation isn't rearing its ugly head like a lot of us think it is, then the Fed's going to start looking and saying, okay, well, growth is starting to slow to a level that we don't want it to get too low here and just stall things out to where we have stagflation. So they need to cut rates, which could reignite growth a little bit more there. But I think they're going to wait. There's no way they're going to be cutting rates anytime soon, because they need to wait for that June, July period to see if the inflation does in fact come. Because if it comes and they cut rates early, that's going to push inflation up even further there. So there's no real data point or anything that's giving them enough ammunition to say, hey, we need to cut rates now. That has been my position weeks ago, months ago. It's my position today. So folks that were calling for 5 rate cuts, again, like I've told you guys in the past, there's people out there that are for headlines. If you just look at analysts and price targets and things like that, it is their job to be bullish. My job is to help retail investors like you. We have a community at the Stock Investors Edge Our focus is for the community to build generational wealth. We are not trying to beat the person next to us. We are trying to lift up the person next to us. That's what our community is about. That's why I teach my courses, and that's what we'll be teaching in that 3-day option workshop. So I hope you guys can join us for that coming up here. So let me see what else I got for you guys as we were going through. I know last week we did not meet, so we were going through the jobs report. So let me show that real quick. So U.S. payrolls increased by 139,000. That was more than expected. And the unemployment rate still set at 4.2%. So you could see a nice little gain there, better than expected, but still very low, we should call it, as compared to the past few years. In terms of U.S. wage growth, that's sitting down here in the lower. But we are seeing this curvature upwards, which could this be the start of a trend moving forward? Let's hope so for the average worker out there. Hopefully this bottom of July 2024 is in, and we can start seeing a nice little increase there. So do know, though, that, when you look at these year over year growth rates, you have to keep in mind what were the comparables. So know that in July, the growth was very low here. So heading into July report this year, have that in the back of your mind if we see a big spike. Okay, so keep that in the back of your mind. And then we go down here to unemployment, which again was down below 3.5%. We are now sitting at 4.2, which is really where we've been since pretty much summer of last year. So not much, we ticked down to 4%, albeit briefly there in January, but now we're sitting up, 4.2%, somewhere we've been for a couple straight months now. So again, the jobs market continues to look decent. There's no real red flags that I'm seeing overall. I'm hearing about some layoffs. There's been some here in Orange County that I've read about, but again, it's been, a few hundred folks. I know Microsoft had some layoffs as well in their gaming area. So, overall, the job market looks okay. I don't think there's any major red flags that we've seen so far. So still plenty of growth drivers up there, but in the near term, there's reasons to be, pessimistic as well. Taking a look here at the Fed probabilities. Again, the next meeting comes on June 18th, a week from today. And we can see that there's a mere pretty much 0% chance that they cut rates. The futures are looking at a 98% chance that we keep the 4.25 where we're at right now is going to be what the result is when that meeting comes and goes. In fact, that's where we're going to be in the next meeting, which is going to be in July. Again, nothing coming, but what are we waiting for? June and July economic numbers, PPI, CPI, and things like that. Where is inflation after the June report? Where's inflation after the July report? Then things start to change. Then we see a 57% chance that we could be seeing a 25 basis point cut, which is where we're going to be for October as well. Not overwhelming, but if you take the 40 and the 24 here and the 3, there's a 65-70% chance that we could get a second cut come December. So right now the market is still believing that we get 2 rate cuts. I'm still in the camp that we get 1 rate cut. And that'll probably be around that October period, potentially September. It all comes down to that June and July economic reports. Okay. If we see something that falls off in the job market, if the trade deals come in and we have less of that periods for management to say there's less uncertainty out there, and if they're worse than expected for businesses have to make the tough choices. That's where we could start to see an impact on jobs. And we start to see an impact on jobs, we could start to see an impact on the economy. We start to see an impact on the economy and spending, we could see a negative impact on GDP, and it's just a snowball effect from there. Okay, so if that doesn't, though, we could be open the floodgates again, and we could have a strong second half here. So in the near term, looking for maybe a little bit of a pullback. We're not going to fall off a cliff. We're not going to go back to April 7th lows. That's at least not my vantage point here, but I think it's healthy for a market, but look for buying opportunities. Okay. We creep back in with the S&P 500 where we at right now. We're at what's a little over 6,000 there. If we get down to that 5,900 level once again, could be a spot to start nibbling. We get below that, probably a little bit more aggressive overall from that standpoint there. So one more time, though, for those of you that joined us late, next week we have a 3-day option challenge. Hopefully you can join us live, but even if you cannot join us live, you will get the recording for each and every day here. Whether you're a complete beginner to options or whether you've been trading options for a couple of years now, we're going to be diving into options like we never have before, giving you examples, giving you real world examples of options that I've looked at, options that I'm currently looking at, so that you understand the why behind it. You know, that I could post option trades all the time. You could follow them if you choose to, but at the same time, you may be asking yourself, I wonder why he's doing that. I get it all the time in our Options Edge Discord community. That's what this is centered around right here, is to give you the why, give you the tools that you can look at different option strategies that say, hey, based on my risk profile, based on my overall account balance, this is a strategy that I might be able to implement. And maybe you're not going to start generating $5,000 a month like my goal is right now. But that's not where I started. I started with a couple $100. And that's how you start these things. Gain confidence in what you're doing and then build upon it from there. Okay. That's going to be the goal behind the 3-day option. We'll be meeting on Tuesday, Wednesday, Thursday of next week, 5 p.m. Pacific time, 8 p.m. Eastern time. There's a link down in the description. And when I mean spots are limited, they are limited. We've already sold out 50% of this entire event right here, just in the first 2 days that this thing has been available here. I guess today is technically the 3rd day, but we've only been pushing it for about 3 days now. So if this is something, again, that you are interested in doing, make sure you save your spot, because they are going to go fast, especially as we get closer to the event there. So hope to see you guys there for our 3-day option challenge. Again, it's been fantastic being with you guys. Missed you guys last week. So with that being said, we may or may not have our stock market after hours next week, because I will be gearing up for this option challenge day 2. So if you miss us, hopefully you can come join us at the 3-day option challenge. I would love to have some interviews to do with other folks that have been doing options for quite some time. So I'll see if I can muster that up as well for the 3-day challenge. But again, there's a link down in the description below if you're interested in joining this or just checking out more information on pricing and things like that. So definitely check that out, and we'll see you there. So thank you guys for joining us today. Let me see if there's any last questions. Good night, Mark. Last Choi, thank you. One of the best for sure. I appreciate that. Q, thanks for being one of the few YouTubers that isn't all clickbait. I appreciate that. That's always the focus. And, you know, I said it in the last video when we talked about selling stocks. Not something I do a lot, but that can get emotional for people, especially when you talk about retail type of stocks that can have meme-ish qualities to them. But whether folks agree with me or disagree, I prefer it that way, because that's what makes a market a market. And we can see different vantage points and things like that. But my ultimate goal, as I've said a million times already today, is to help you guys build generational wealth and give you my vantage point on the stock market, where we're headed, and where I think we're going long term. So thank you guys for joining today. It's been great to be with you. With that being said, we will hopefully see you guys at the 3-day trading event. If not, we'll see you at the next Stock Market After Hours. Have a great evening. Bye-bye.